Economic recovery continues to stall, what it means for Australian investors, and we take a look at the upcoming reporting season. That's next. It's your daily 10-minute business and finance news wrap for this Monday, the 17th of July, 2023. China's economy continues to stall, the nation reporting a 6.3% expansion in its GDP year on year to be up 0.8% on the quarter. Although that's a little less than expected, there was an improvement in manufacturing, but retail sales growth disappointed amid a worried consumer. So what does this all mean for China? And what about for Australia, which relies on the nation because of the two-way trade? For more, I spoke with Raymond Chan. He's the head of Asia desk at Morgans.
My Chinese contact keep reminding me that this year China year-on-year number will always look beautiful, always looks impressive. Why? Because, the low base is a result of China lockdown exactly 1 year ago. Back in June 2022, so a bit over a year ago, China recorded almost no growth, zero growth. So now, obviously, China reopened at the beginning of this calendar year. 1 year on, today we got 6.3% from a low base. So we think, the bounce back is pretty weak. More importantly, these figures is actually well below the already cautious market expectation of 6.9%.
Which part of the Chinese economy is causing the most concern?
Let's take a step back. I think most people are very comfortable with the household saving in China. They have a record household saving, close to $18 trillion RMB at the end of 2022. Now, the issue with China that caused the concern by most is people don't want to spend. But why people do not want to spend? Because there's a number of uncertainty. We have, the property sector being very uncertain. We have the social unrest as a result of unfinished off-the-plan product. We have the youth unemployment. Today's figures telling us there's another record youth unemployment rate of 21.4%. Last month was a record. So that was the May figures. Today is the June figures, another record. So with so many youngsters unable to find jobs in China, that caused a lot of concern. And remember, there's very limited safety net in China, so people pretty much have to rely on their own saving. And more so, of course, people have concern about the inflation. The recent CPI figure seems to be again below market expectation. Last but not least, we have the local government debt. As long as the local government finance vehicle, that seems to caught a bit of attention of late as well.
That's interesting about the savings comment that you made. So there's the potential for this savings to be made. So with that in mind, what do you think all of this means for the potential of more economic stimulus? Because we know that the central bank in China over the past 3-4 weeks has already been cutting some key interest rates to try to stimulate the economy.
Since the beginning of June, we have seen a number of measures by the Chinese government, ranging from support for the EV, support for the property declaration. We have the Chinese premier meeting with the platform company to show support. However, with today's Chinese figures below market expectation, it all pointing to the likelihood of stimulus. There could be, a China Politburo meeting toward the end of this month. Last year, we had the same meeting on the 28th of July. This year is yet to be announced, but it will be around the same time. The meeting is important because this is when major policy to be announced. So I think, that there's still quite hopeful, that there will be a stimulus measure to be announced pretty soon.
In the meantime, though, what does it mean for Australia, the economy, investors, and government finances, no less?
For China, in terms of our economy, I think China remains our biggest trading partner. So it is important. The China health is going to impact the product that we are selling. The student that we're going to take for our university. As for the investor, look no further than this week production report from BHP and Rio Tinto. You're going to see weakening demand for our iron ore. That is well flagged to the market. However, I think the biggest miner will take the opportunity to just provide a bit of their view about their biggest customers. How do they think about the economy going forward? But in terms of investor, this is quite important because this is the last production report before the August reporting season. Last but not least, there's a lot of talk on the local government finance vehicle in China. To put it in the perspective, the market concern about the size of it is around $60 trillion renminbi. So $60 trillion renminbi is around 12 trillion Aussie. That equivalent to about half of the GDP of China, or 6 times the Australian GDP. Okay, but take a step back. Out of this 60 trillion local government debt, about 40 trillion is with the major Chinese bank. And that 40 trillion with those Chinese banks only account for about 12 to 15% of their total lending. So first of all, majority of those debts are with the Chinese bank, and we think the Chinese bank will be able to well contain those debt levels. So in terms of the stimulus, if there's any stimulus, one thing the central government can do is they can accelerate some of the payment to the local government to address some of that debt issue.
You mentioned reporting season there. We'll talk about that in a couple of moments. But first, overall then, are you optimistic or are you pessimistic on the way China is managing itself out of the pandemic? Because there was really a lot riding on the success of the economy coming out of that prolonged lockdown. And there was a bit of excitement towards the beginning of the year from investors.
Absolutely. We recall, at the beginning of the year, most investment banks were pretty optimistic on China reopening. So the China reopening itself is a trade. Now, of course, with the month-on-month figures disappoint, most of these optimistic comment has long gone, and they are now getting really bearish. That actually, in turn, make the investment in China or China-related investment less risky because of the low expectation. So I think the way we look at it is, I always find opportunity, when people's getting so bearish out there on a particular investment. One good example is Japan. Last year or for the past 20 years, no one really want to talk about Japan, but there we are. A bit of good news. Japan is on a multi-decade high in terms of their share price performance. So never discount these second biggest economy in the world and our biggest trading partners.
Raymond Chan there from Morgans.
Now, Market Day on the SBS On The Money podcast.
There wasn't a lot of reaction on the Australian share market, which fell only slightly. The S&P ASX 200 down 0.1%, 7,298. What does this all mean for investors? And what does it mean for Australia, this economic slowdown in China? I continue my conversation with Raymond Chan from Morgans.
The market is pretty flat, but what I note is as soon as the China figures coming out, the miner actually fell less. There could be hope, there could be some sort of stimulus plan coming out soon. And more so, I think for now, after a big week last week on the Australian share market, we usually see a bit of profit taking, but today the market are quite well contained. So that actually, I see it pretty steady. And I think a lot of people are sort of holding off to see what happened to the production report toward the end of the week.
Okay. Speaking of reports, reporting season starting quite soon, I think towards the end of the month, August as well. What are you expecting to come from it?
The market talked a lot about the China slowdown, but across the board globally, the PMI, the leading indicator of the economic growth, are slowing down. Yes, we have a pocket of few countries doing really well. The PMI is still going up, such as India, but the like of US, Europe, economy is pretty weak. Australia is not immune from earning deterioration because with weaker economy, we're likely to see weaker earnings from the company. So far, when we look at the ASX 200 for the financial year 24, so this financial year, the consensus is looking for an earning to go down by about 3%. That doesn't sound too bad. But of course, we come from an environment, initially the market expecting, the earnings to up 5%. Now we have down 3%. So that certainly sends some disappointment to some investors. And when we look at where's the biggest earning downgrade coming from, we have, the finance, the energy company, and the consumer stock getting the most downgrade. And on average, about 50% of the company, we expect there will be an earning downfall for this financial year. So that I think that this is the backdrop for the reporting season. Yes, there will be earning downgrade. There will be some disappointment. However, much of this already factored into the share price. And when I look 1 year on, which is financial year 25, actually the market is looking at earning bounce back by 5%. So love is not lost for the share market.
And very quickly, in the meantime, then, where are the opportunities for investors?
For the investors, I think the defensive stocks are continuing to do really well. I think they will report pretty respectable earnings. However, more so lately, I think the small cap could be an opportunity. The small cap stocks has really significantly underperformed the rest of the market, not just in Australia, but globally. I think small cap company, a smaller company, will be an opportunity for financial year 24. For some of the investors, smaller company may be too risky for them. However, we can rely on some of the funds manager who are specialized in those areas so that we have a diversification in our portfolio.
That's Raymond Chan there, the head of the Asian desk at Morgans. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.